All right, we have a double header on this episode. We're going to be talking about money and not your money, other people's money, and how you can find opportunities with hard money. And we're also going to be talking about, probably more importantly, which will pertain to so many more people, is how to go from a W-2 employee with a side hustle to a full-on career and being driven by passion. And we're going to be talking to David. Welcome to the show.
Thanks for having me. I appreciate the opportunity.
Yeah, this is great to have you on. We'll start with the first teaser I put out there, and that's the hard money.
Sure.
Just briefly, just give us a little hint on what that's about and where you work on that, and we'll come back to that again.
Sure, absolutely. So I'm one of the principals and co-founders of a company named Crown Capital Resources, and we are a hard money lending company, lending in both residential and commercial all throughout the state of Texas. It's something that I've been running for 8 years now. The vast majority of which time has been as a what we'd call side hustle, been running it on nights and weekends until ultimately transitioning to it on a full-time basis. Almost a year ago, I resigned from my engineering role on March 10th of 2024. So big life adjustment, big transition to me, but I'm now pursuing it full-time, and it's been, just a blessing and a wonderful transition, both for me personally and professional.
In real estate, there's so many people in any side hustle, there's a side hustle, right?
Yeah.
And bridging that gap from that, breaking away from the W-2 is horrifying for a lot of people. And I think more importantly, how to get that side hustle up to enough of an income stream to be able to make the transition. So you give us a little idea of what that was like when you were doing both.
Yeah. So the first thing I'd say is I've got a lot of respect for the entrepreneurs that just take the leap of faith, and they are not financially there, but they just bet on themselves and they resign and they just make it work. My story is very much the opposite of that. From my perspective, I started as an engineer 15 years ago, and I always had a passion for real estate. And it was never, to be clear, it was never an exit strategy for me. I never did any of these real estate things to jump from my W-2, but I started in single family homes, started building a rental portfolio, and then kind of got interested in some raw land development. So did a deal out in the DFW area, did some Airbnbs, acquired and managed them. And then I even did a hard money loan passively. And for us, we had a friend, me and my co-founder of the business, we were actually looking to flip a property that we had a friend reach out and say, hey, I've got a property that I need money on. Would you guys be willing to lend? So we were able to scrape some contracts between the internet and some of the deals that I had done recently. And so we kind of fell backwards into this, so our first hard money loan was 2017. And what we realized at the termination of that first one, we thought, well, number one, this is a lot more passive than a lot of things that we've been doing in real estate.
Right.
And it's very compatible actually with being able to be in a W-2 on a full-time basis and then being able to kind of run this business as a corollary. So for years and years, we ran it in the background and it just took a lot of weeks, but it was something I was used to, working a lot of hours every week. And really the pivot was in 2024, where the engineering role it's a high income role, but it was, obviously pretty stagnant over time. And the Crown Capital Resources had grown and grown until the point in 2024 where they crossed over each other.
Nice.
Yeah. So it was a slow burn. You transition and you jumped and you replaced salary. And I'll say yes, but it was 8 years before that happened. It
Right.
took a very long time. So for anyone who's starting out, just remember, do it out of passion. If you find something you really, really love, then you just work at it until the point where you feel comfortable making that transition.
What's going on in your head when you're working two very different gigs? Once you're reporting to somebody and you have to perform because they're paying you to perform.
Yeah.
And then you're doing this other thing that's a passion that or plan to grow. How do you balance that mentally where you're not letting go on either one of them?
Well, the short answer is you are. If I'm being super honest with myself, I felt in the back of my head like I wasn't giving either role 100% of myself.
Okay.
And the reality was I realized that's kind of an injustice to both sides of it, and I was still high performing in the engineering role. Things were going really well there. But, as I mentally started to transition and mentally explore well, what would this look like for me as a full-time basis? I could definitely see a lot of the passion on the engineering side waning a little bit, but that was tough. And, and another thing another part of the story is ultimately where this culminated to was my wife had a coming to Jesus talk with me in 2024. And she's like, hey, you've got a full-time engineering role. Your side hustle is blowing up and you got young babies in the house, young daughters. She's like, one of those three things has got to change. Like,
Right. It's good you didn't get rid of the kids.
well, yeah, I was like, and for me, it was a no-brainer at that point. I had already, I was like, yeah, okay, I'm resigning from the engineering role. I'm going full-time in the business. Let's go.
That's fantastic. Good for you. Is there a sense of relief when you did that? Or
Yeah.
was it more, I just jumped off a plane and I know this is it going to last? What was that?
Absolutely the first. It was a huge sense of relief for me to be able to essentially release 40 hours of my life.
Right.
So I would say like not a stressful juncture for me. Financially, we were in a really good place. This has been running profitably for 8 years. We were making, good income in there, more than the engineering role and all those different things. And for me, it was just a massive relief, be able to take back more of my time. And for me, where I ultimately land, and this is like a whole nother journey we could talk through, but I had to do some soul searching and figure out what was really, really important to me. What critical items do I really need for happiness? And it wasn't all the usual suspects, which people typically say, which all kind of revolve around money.
Right.
For me, it was just the autonomy to control my own time.
Nice.
And once I had that aha moment for me personally, I realized that no matter how incredible your W-2 role is, like you will never control that.
That's
so
right.
that was my light bulb moment.
40 hours is now yours. What are you doing with it?
Yeah. So I resigned in March 2024. By November, we had doubled the size of the lending company.
Wow.
So
with employees or with volume?
In volume. So typically for a hard money lender, one of the key metrics that you track is just notes funded. So the total amount of notes funded doubled in that time period to the point where, in fact, my business partner, he ended up resigning in late October because he saw it as well. He's like, man, we just doubled this. And I was like, yeah. Wow. So we're now to the first time full time in the business.
So you got to start seeing even more growth.
Yeah. So we want to double one more time this year. That's our goal.
Fantastic. Aggressive. It's fantastic.
Yeah, I know. It is aggressive, but it's the first time we've ever been able to fully allocate 40 hours to the business. And not just from the time standpoint, but just from the mental focus, it's been a big difference.
I bet.
Yeah.
What did that, aside from that, obviously at the time,
yeah.
How did you use that time to get the more deals?
In a weird way, being able to work on regular business hours as kind of the rest of the world. Because keep in mind, I was kind of working on, I'd catch an hour here at lunch and then I'd work on it on Saturdays and Sundays. But being able to transition that workload to the working hours, number one, did make a big difference. And number two, I started treating it like this was going to be a long-term career. So focused a lot more on goal setting. I started incorporating an EOS system, the by the book traction.
Nice.
And really tracking and measuring what our goals were going to be, following Patrick Lencioni's scoreboard model and figuring out, hey, what are our goals, what are standard operating objectives, what are defining objectives, and then really using that traction model to basically track it on a weekly basis. So we got a lot more regimented.
Did you go through the EOS program or you just used it from the book?
We did basically a self-study.
Okay.
Yeah.
Yeah. It's a smart program.
It's a great, when you read through the book, it creates a great model of how exactly to do it. You just have to be diligent and actually work through it.
Yeah. Don't deviate from the meetings. How often
yes.
I've seen people get into it. They're all gung-ho. They pay the money for the consultant and then they decide to tweak it themselves and make it their own. And that's not the way it should be. It's a model. Right. For a reason.
Yes.
Right.
Exactly.
So how do you and your partner share responsibilities?
Yeah. So right now we're kind of split a lot of things. It is one of our goals in 2025 to figure out how we're going to kind of segment the business. The reality is a good piece of our business is loan originations, just initially evaluating the properties, putting term sheets together, talking to clients. And then a big piece of our business as well is third-party capital fundraising. The reality is we need to split those roles because I live in Houston and a big lion's share of our business is in the Houston area. He lives in San Antonio. Lion's share is there in San Antonio. So we kind of do territory managers. But the fundraising, as you know, we've got to be hitting that every single week because the way to think about our business is Crown Capital Resources essentially has two segments to the business. On the left-hand side, we have Crown Capital Resources, the servicing company, where it's the operating company that actually initiates the loans, services the loans all the way from origination to payoff. And then the other segment of our company is Crown Capital Income Fund, which is a 506c income fund that we raise capital through third-party investors. And, that capital fundraising is flat out, it's hard. It's very difficult. You've got to stay on it week after week. And it's slowly cultivating conversations and relationships and getting people from, initially reaching out to the point where they feel comfortable enough with you as an individual, as a fiduciary, and the underlying business proposal of the operating company. Once they're comfortable with those two things, and then usually they'll invest. But sometimes that's a 6-month process.
How do you even identify the prospects for that?
Yeah, initially it was really easy. We have a pretty strong family and friend network just from typically speaking, petroleum engineers make a really good income. So a lot of our initial investors, in fact, even today, like about 80% of our investors are first tier connections.
Okay.
Right. So they're people we went to school with, people we graduated with, or know from the oil and gas industry, family and friends.
Gotcha.
Once you move past that, that's where it becomes a lot more difficult. My general thesis right now on fundraising is that a cold lead is a dead lead. Like, it just doesn't exist. There is no such thing as calling somebody on the phone from a call list and introducing yourself and asking for money. It just doesn't work. So one thing we're actually focusing on, and it's been going well for us, is we're taking our tier 1 connections and then essentially asking them to stack a table with other friends and family that they might have. So the pitch would essentially be, hey, you've been with us for 2 years. You've kind of seen our business model. We're growing and expanding. Do you think we could set up a dinner? And we're happy to host you guys at, XYZ Steakhouse. Do you think you might have 3, 4, 5 friends or family that would be interested in this? And that's been really effective because you're sitting there at the table and you have an advocate sitting there right next to you. And so you see it during those conversations, right? You're talking about the business and how functionally we work and this, that, and then they're kind of looking over at their friend, family member going like, is that right?
Yeah, that's great.
So it's been good. That's worked out well for us. But, the funny thing about this business is those two segments, which is the deal flow pipeline, if you will, new deals coming in our desk, and then the fundraising things, those need to grow in tandem in our business.
That's right.
And if one outranges another, it can get, it can get really tricky. It's a constant grind. And for us to this point, and for the last several years, our limiting growth factor has been the third party capital fundraising.
Yeah.
It's tough. It's just tough, and you've got to work on it every week. And we have goals built in every week to, make X amount of connections or calls. And it's like some weeks you can call 20 people and it's like, it was a goose egg. And then sometimes you can sit down to a breakfast with a guy and 15 minutes later, he's like, yeah, I don't need any more description. I'm in.
That's great. Well, let's talk about the risk side on the lending side. What's going on? What are you seeing in the market? How are you evaluating your properties?
So for those that aren't aware, hard money lenders, the defining objective of what is a private lender or a hard money lender is that we essentially make a loan out onto a property and then take a first lien position. So hard money lenders are always in a senior debt position. If anything goes wrong, we ultimately take back the collateral. And that's what makes us different than, a lot of other just different loan products out there. So the biggest risk mitigation that we can really have is ensuring that when we underwrite deals on the front end, we're underwriting as conservatively as we can. So typically on our portfolio today, we're at 60% loan to value.
Okay.
So to put some numbers to that, if the total real estate that we had notes on was worth $1 million, we would have $600,000 worth of actual capital out on that leverage. So that's what that really means. On residential, we'll go up to 70. On commercial, we'll go up only to 50%. So that's our first mechanism. But what we are seeing in the market is a lot of people have seen it. We're seeing a lot of slowdowns. We are now entering about 18 months, arguably 24 months of substantially lower transactional velocity in the market. Things are sitting on the market longer. You're seeing a lot of price cuts. And another thing that we track in our space is change in inventory or increased inventory is usually a leading indicator to price reductions, right?
Are you meaning inventory on the market?
Yeah.
On the market inventory?
Yeah.
Okay.
Yeah. So, and what you see if you look at the data for Texas right now, especially in some of the major metropolitan areas, which would be San Antonio, DFW, San Antonio, and Austin, is that, we were at relatively stable levels of inventory pre-COVID. And then obviously COVID saw a massive reduction. And then we are now seeing us revert back to or even slightly above the longer term trends. But that the rate of change and increase in the last 2 years has been pretty staggering.
How does that affect your lending? Is it the liquidity of it that is the concern?
Yeah. So from our operating company, the biggest effect is that it actually does reduce our net income. And the reason that is because the biggest profit driver for our business is actually the origination points. So when we take that big pool of third party capital dollars and we're able to deploy that into 6-month deals and basically flip that third party capital over 2 times, we can make 6% on that because we charge 3% origination.
Right.
And so what we're seeing now is we're seeing our general loan length drag out a little bit longer.
Okay.
And so that does ultimately, when it all rolls up, it does affect our net income as a business, but we're not seeing a lot of issues on foreclosure still. In 8 years of operating history, we have only had one formal foreclosure in the business.
Right. Yeah. That's fantastic.
So we're conservative by nature. We're engineers by background. So we underwrite really conservatively. But yeah, we are seeing the slowdown. And when we're having conversations with borrowers, before we used to say, hey, like you need to make sure to have 6 months of interest liquidity to make sure to pay this note. Nowadays, the conversation is you probably need to have 9-10 months of liquidity just in case this property hangs on the market longer.
Right. So you take your interest payments all on the way. You're not stacking them at the end. Interest.
We do. Absolutely. In fact, we strategically chosen to do that because I think it's a good health check.
Yeah.
I think that's kind of your leading indicator as to something being wrong.
That's right.
Right. Because if you've got a $200,000 note out with somebody and they're not making a $2,000 a month interest payment, that's a red flag. You need to figure out what's going on there.
Right. So who are your clients on that end of it?
So our clients, basically the segmentation is essentially 2 groups, kind of arguably 3. So the first of which is kind of your full-time flipper. Typically speaking, the background of this individual is I had a career in XYZ and I started flipping homes and I fell in love with it. And now I just flip homes. So these people that is their bread and butter. That's how they feed their family. They flip homes. And the beautiful thing about them using hard money is, as you know, and this is what I tell people, like when people typically say like, why do hard money lenders exist? I say, well, think about it. If you're in Houston, Texas, and you're a flipper and you've got $300,000, that means that you can flip one house at a time, right? And you compare that with being able to say, well, if I can use hard money, I can take that $300,000, leverage it up, flip 5 properties at a time. And then at the end of the year, instead of having flipped 2 properties, I'll have flipped 10, right? So I tell people, don't get hung up on it does erode your net margins on a per property basis, but the magnitude of what you're able to accomplish far outweighs that.
Yes.
So that's about 75% of our clients are flippers. And then, probably about 15% of our clients are people who are full-time real estate agents. And what they do, their strategy is as they're driving in their neighborhoods and they're seeing a house, they're constantly going out there and making cash offers. And every once in a while, one hits, they'll give us a call and say, hey, I need to close this deal. And typically those are very small renovations. It's just getting the property back up to like median expectation. So it may be flooring, granite, some paint, and then they put it back on the market.
Right.
And then the third category of clients for us are more of the commercial clients. So they're property developers or business owners, and they're looking for some cash to expand their warehouse, or they're looking for a bridge note until the longer term construction loan can come in. And the commercial ones are always interesting. I love working them because there's always a story that goes along with it all, it seems like. Yeah.
What are let's go back to going from W-2 to entrepreneur. What is the surprise? What are some of the surprises you've had now that you're only an entrepreneur?
Being as like modest as I can, one of the biggest things for me is the pride. I love saying that I work for myself. I love knowing that I'm working in a business that I built. I love the legacy aspect of it, and and the security of it. And I'll expand on that. Like legacy for me isn't leaving my name on some sports complex.
Right.
Legacy in the short term for me is such that if something were to happen to me, the business would carry on and my family would continue to receive the distributions. And so that was one big thing that me and my business partner worked through. And I would actually recommend this to anybody who has a business partner. We worked through a book called The Partnership Charter that talks through you and your partner working through all these different circumstances and incidences and random things that might happen in your business and determining on the front end, like, how do we operate in the case that this happens? So it's things that there are some things that you wouldn't ever really, you don't want to talk about, or like you wouldn't talk about. It's what happens in the case of partial incapacitation,
Right.
what happens there. So we actually worked through all that, created a partnership charter, and then amended our business operating agreement. And for me, I was just thinking, man, like that's incredible, because if something were to happen to me, my family isn't just in survival mode. Like they're still going to be able to thrive, and for his family as well. Right.
Yeah.
And so I love that aspect of it. I absolutely love it. So, but, and the second thing for me is, like I mentioned, the important thing for me is autonomy over my own time. And I'm working, I would say 40 to 45 hours a week. I'm not overworking. I'm not underworking. But it's definitely, I have a lot of friends that joke with me like, how's retirement? And those,
Yeah.
I'm like, I'm not that. It's not that, right? But it does feel so much better because the work I'm putting in directly correlates to the overall income of the business, which is amazing. And this is one key thing I tell people who are in the W-2 space. It's like, think about it this way. If you are working in a W-2 role and you just like bust your ass and you're working 80, 90 hours a week for the company, and even there you're recognized like, hey, you're doing an amazing job. And they say, hey, congratulations, we've increased your bonus by 50%. But then you realize like your bonus is only 20% of your comp structure. So on a net basis, like, and then you take out 35% for taxes. It's like on a net basis, it's not looking that great. It's like not that meaningful of an impact. But, like the story that I gave is like, when I was able to fully dedicate and I went from part-time to full-time, we doubled the business. That's 100% more money, which is amazing. So I always tell people like the ceiling for moving into a small business owner or things like that is just dramatically higher.
What's the structure of your company? Do you have staff?
We do. So right now, the principals are myself, and then we have two ladies that work with us, Linda and Abby. Linda is our loan processor. So she handles everything from approved term sheet all the way to wiring, which, the funding. And then Abby, we just hired her on. We don't really know what role she's going to ultimately fulfill. Right now, we basically have her marrying Linda's responsibilities, but I think eventually she'll move into a lot more of the servicing operational side of the business. And that will free Jeremy and myself to, as you hear in books, like work on the business, not in the business.
Yeah.
And, and for us to be able to free ourselves from the day to day and then work on things that are a little bit more intangible, but they're ultimately going to, really accelerate the growth of the business.
That's right.
I mean, right now we're still kind of doing everything on the operations side.
Where do you see, what's your 10-year plan? How big you guys going to get?
I think we're a little bit undecided on that. Right now, we're at 25 million in our 1-year plan is to get to 50 million. You call it 40 to 50 because we started the year at around 20. But to be honest with you, I think our 10-year plan, my 10-year plan personally revolves a lot more around what work-life balance looks like, what health looks like for me, this business being what I call a lifestyle business. And it's a lot less about what's the total AUM that we're going to hit.
Right.
And so, and I have, there's a really good exercise that I went through. It's like a 10-year life goal, but the exercise essentially, you sit down with a piece of paper in a quiet room and you write out what your life looks like in 10 years. And you go through excruciating detail, like where I'm waking up, what time I'm waking up, who I'm waking up next to, what my home looks like, what does my first hour of the day look like? You work through all that. And so for me, when I did that exercise, it was a lot more about connections, health, family, and a lot less about certain financial metrics in the business.
Nice.
Yeah.
So going to the second question I had on that was, you're on your own. I know you have things set up in case something happened to you. What about, and you've built a business underneath you. So you do have 8 years of groundwork underneath you. Is there any fear that could slip away, or any negativity in your brain that you have to talk through? Or are you guys like good to go?
I think for me, it's going to be the continual pull of growing for the sake of growth and, making riskier business decisions. And we had to something you fight against. Like one internal struggle that we've been talking through with Jeremy and myself is when you raise capital, typically our cost of capital, or what we pay our third party capital investors, is 10% per annum. Well, another optionality for us would be we could essentially do note on note financing through the bank. And that's, call it prime plus half. So, you're talking maybe 7.5% or so. And so of course, the temptation is to just lever up on bank leverage.
Yeah.
And the argument there, of course, is like, well, what does 20, 30 million in 8 times an extra 3% arbitrage look like? And it does seem attractive. But the issue with that, just like this lender that I just talked about that just went bankrupt, like when things go wrong, everything just snowballs into, and ultimately there's just a dissolution of your company.
Is that bank quicker to pull the money, to call back the note?
Well, so essentially what happens with the bank is they do a note on note financing. So you essentially take the note on as a senior debt position. And if you take a note on at 60% loan to value, the bank, in order to give you that note on note financing, they will actually subordinate your debt. So they'll actually put a senior debt position on top of your loan, but then they'll give you 50% of that loan to value.
Gotcha.
So if the initial loan was 100,000 and we lent out 60,000, the bank will take a first lien position, but then they'll give you, 30 to 40,000. So the problem is in this particular company's scenario, like they had 3 big loans, commercial loans that they lent out, and then they did bank leveraging on top of that. The loans went into bankruptcy. They had a hole in their balance sheet. They couldn't pay back. And then the bank started taking on their loans. But because what they owed the bank was so much more, they ended up cascading and losing loans after loans in order to pay back the bank.
Right.
So it's like, you say, it's like, I know I can quantify the upside for making this move. And like, as an engineer, you would say, yes, quantifiably, like we need to do that. That makes sense. Because not only is it, a higher interest arbitrage that you could get, which ultimately affects your net income, but the second thing about it is it's clicking the easy button for fundraising. Right. It's like, oh, you want another $10 million from the bank? No problem. Right. But and so you look at that as a hard money lender, you'd say, well, or option B is I've got to go pound, the pavement for another year to go raise another $10 million from third party capital investors. Like one is way easier.
Right.
But the downside risk, to me, it's just not worth it.
Yeah, I get that. So there's nothing that's keeping you up at night?
Right now, business is pretty good. We don't have anything heading towards foreclosure. We did go through our first foreclosure last August, and it was, annoying, but it was a lot more, painless than I thought it was going to be. Right. In Texas, it's a really quick process. It can be as quick as 43 days from demand letter to foreclosure auction. Yeah. So no, not right now, but there are definitely challenges. And when things, one big pivot that's interesting is it's a lot harder to quote unquote turn it off when you're a principal and it's your business that you're running, as you could imagine. Yeah. And so it's like you're on vacation and you're thinking to yourself like, this is nice, I'm on the beach, but gosh, my inbox is stacking up, or I wonder what's going on with that deal. So that's been a little bit of an interesting challenge for me to kind of turn it off and then, transition into dad mode, family mode, and things like that.
Yeah. I get going back to the funding piece.
Yeah.
Are you able to tap outside of Texas and bring money in from out of state?
Oh, yeah.
Okay.
We can bring money in from our third-party investors can live anywhere in the U.S. And in fact, we're kind of looking at onboarding our first international investor right now.
Okay.
It's a little bit more complicated. You have to have a U.S. entity set up.
Yeah.
But yeah, that's the nice thing about fundraising is it can go anywhere. In fact, we had a investor of ours who lives in Arizona, and he gave me a call and he said, "Hey, I'm here with my brother and my business associate. Could you fly up here and have dinner with us?" I was like, 100%. I'm on my way. So I took a day trip to Scottsdale, had dinner with them, enjoyed ourselves, and then flew back the next morning. So yeah, I tell people who may or may not have any interest, it's a passive investment vehicle. There are mechanisms of safety built in, not only from the business model, but actually the fund structure itself. And I always tell people, if at all interested, shoot me an email and we'll set up a call. And if you're still interested, I'll fly out and meet you.
What's the buy-in that you'd pay attention to? Do you have a minimum?
Yeah. So our minimums are 50,000.
Okay.
Yeah.
That's not uncommon.
As a third-party capital investor, obviously you have the security of the business model itself, right? So on a composite basis, we're at 60% loan to value. So it's like today we've got $25 million of notes out, but the real estate it holds is worth, close to 36 million. So that's a really good over collateralized position to be in. And then the second thing that we did was we set up the fund such that investors are paid out first. And so typically when you set up these funds, I'm sure you've seen a lot of these PBMs, it's like top line comes in and then it's management fee and then it's like business operating expenditures, miscellaneous. And then on the bottom of the capital stack, you have investors. So what we chose to do is we actually took that structure and we inverted it. and we said top line revenue comes in, first people get paid out, investors. It's once they are paid out and paid out fully that I'm even able to take a salary or pay business operating expenditures or whatever. And then on the very bottom of the capital stack, once everything's paid, then it's like optional shareholder distribution, which would be for me and Jeremy.
Yeah.
And we did that because, well, quite frankly, the fund is primarily friends and family. And,
Right.
you know, it's like if we're going to lose anybody money, we got to be sitting across the people from, you know, the Thanksgiving table. But also, you know, when you're in a position where you're raising a fund, like you are a fiduciary, and that is a huge responsibility.
Absolutely.
Yeah.
Absolutely. Wow. Pretty cool journey you've had. Pretty exciting.
Thank you. Yeah. The thing I would tell, you know, especially young entrepreneurs who are kind of starting on this journey is it can be very discouraging to listen to podcasts and hear, you know, people kind of once they've found their success and all those things. But what I always encourage people to do is just start where your passion is. Cause I knew my passion was real estate, and it took me trying 4 or 5 different real estate ventures before I finally figured out like what I am actually passionate about. So if you just start with what you love, you'll figure out how to make money in it later.
And you were grinding for a long time.
Yeah.
So,
Yeah,
you know,
that's right.
look at you now, and people will say, hey, they just doubled their business. The 10-year plan is going to be work optional, living his life, being able to go on vacation and actually enjoy it.
Yeah.
They're not going to see the years of grind that you did.
Yeah.
So yeah, it
right.
takes a lot.
Yeah. Well, and that's why if you start with, I want to make $1 million at year one, like you're just never going to be happy, because guess what? Even if you hit $1 million, that goalpost is going to change as well. So I always encourage people who are even starting this journey or they're getting to prepare their mindset. Like if you really fundamentally dive deep into what you're seeking, the answer is never money. Like, you know,
Right.
money is, and ultimately like money is just an exchange tool, right? Like it's not a scarce resource. You can always exchange more time for money. Really, it's going to be other things, and figuring out what those are and putting yourself in a position to maximize those. Like that's going to be happiness.
Do you see a point when you're working on the business where it's no longer time for money and you actually you're able to pull back?
Yeah,
that's beyond the business.
Yeah, I'd like to. I think, you know, my short term goal is to the thematic goal of the year is to focus on vision, not on tasks. That was our goal for Jeremy and myself. So we're starting to move into that place. Starting in 2025, the way I look at it is I want to be working in the business on things that I really, really enjoy. There are still aspects of what I'm doing on a day to day that I don't really like. You know, dealing with draw requests and reviewing pictures and things like that. Those are things I can offload with time. So to me, it would be, working on everything that I'm working on within Crown Capital Resources is stuff I love working on. And there are things even today, like I really do enjoy, like the investor fundraising for me is still something that is a huge challenge. I enjoy meeting new people and networking in general. So I don't have an issue with that.
Right.
Working on interesting deal structures, like especially on the commercial side, it's a ton of fun. You know, I'll go drive out to the property and meet him, shake the guy's hand, and, you know, go walk the lot or the building. I like that stuff. So yeah, for me, it's moving into the things I love. Call it 2025, 2020. I'm sorry, end of 2025 and 2026. And then after that, I mean, maybe it looks a little even more passive for me, and then it's probably filling my time with other things, you know, maybe going being a guest lecturer at the university, or maybe me doing like a mentorship program here locally. So I don't know what that is, but it probably looks more like giving back and
Good. David, thanks so much for coming on the show. Appreciate your time, appreciate your story, and being open and honest about it all.
Yeah. Well, again, thank you for the opportunity, and I appreciate you taking the time and getting to know me a little bit better as well.
Yeah, absolutely. And I will stay in touch with you. And for the viewers, if you're enjoying the show, please subscribe and hit the bell, and you'll get notified when we have phenomenal guests like David on. Be best.